Hello everyone. Today we are going to talk on the challenges in capital expenditure decision. Capital budgeting is a process in which a business determines and evaluates potential expenses or investments that are large in nature. Throughput analysis is measured as the amount of material passing through a system. The most complicated form of capital budgeting analysis, but is also the most accurate. Throughput analysis belief that all costs except direct materials costs are largely fixed. Maximizing contribution is flawed as to take uncontrolled account cost into consideration, for example, to hire workers on daily basis and lay workers off if they are not busy. Workforce has to be employed within the business and available for work even if no work to do. The company cannot refuse to pay a worker if he is forced to sit idle by a machine for a while. DCF looks at the initial cash outflow needed to fund a project, the mix of cash inflows in the form of revenue and other future outflows in the form of maintenance and other costs. These are the problems relating to DCF analysis. First, operating cash flow projection. Second, capital expenditure projection, and lastly direct rate and growth rate. Payback analysis is the most simple form of capital budgeting analysis and the least accurate. It calculates how long it will take to recoup the investment of a project. Limitations of payback analysis. Fail to take into account the time value of money and fail to consider inflows of cash that occur beyond the payback period. Next, we are going to look into capital expenditure decisions. Capital expenditure decisions is the opposite of operating expenditure decisions. It involves the planning, evaluation and selection of capital expenditure proposals, the benefits of which are expected to accrue over more than one accounting year. Capital expenditure decisions is the process of making decisions regarding investments in fixed assets which are not meant for sale, such as land and building. Qualitative factors in capital investment decisions. The factors are measured subjectively. Ethics, safety, company culture and environmental concerns can affect the decisions. Company culture. A manager should understand the effects the resource could have on the company's culture. Cultural considerations can give a huge impact on the decision. Product/service quality. Capital investments can be made to increase a company's capacity to produce goods or deliver services. Balanced cost and quality can maximize efficiency. Environmental concerns. Capital investments can have varying degrees of impact on the environment, and more financially appealing options frequently have greater impacts. Because of this, the quantitative factor of price can be at odds with the qualitative factor or environmental responsibility. Manager must consider the impact that any capital investment will have on the environment to balance affordability with environmental conscious design when purchasing products. Ethical considerations. It can inject a host of qualitative considerations into a capital investment decision. It be affected by investments in new facilities and equipment. Automate manufacturing tasks can drastically reducing the staff. Installing low-quality fire protection systems can endanger employees on the job. Next, we are going to discuss on current technological advancement. CapEx and OpEx. Capital expenditure or CapEx. A business expense incurred to create future benefit. For example, acquisition of assets will have a useful life beyond the tax year. CapEx cannot be deducted in the period when they were incurred. Tangible assets are depreciated and intangible assets are amortized over time. Money spent on inventory falls under CapEx. Cost incurred for buying the income-producing property. It only assists in the procurement of the item. Takes longer negotiation process. Example of CapEx. Buying machinery and other equipment, acquiring intellectual property assets like patents. Scenario software. It functions to keep an eye on the price with real-time reforecasting of project capital and total project spend in coming projects. It easily generates financial performance reports across the entire portfolio, a single project anywhere in between. It also can streamline and standardize your CapEx management process throughout the full capital project lifecycle. Next is operational expenditure, which also known as OpEx. It refers to expenses incurred in the course of ordinary business such as sales, general and admin expenses. Operating expenses are fully deducted in the accounting period during which they were incurred. The money spent turning inventory into throughput is OpEx, cost associated with the operation and maintenance of an income-producing property. Everyday items bought on regular basis and minimum stock levels kept. Has no maintenance costs. Examples of OpEx are wages, maintenance and repair of machinery, utilities and rent. From income tax perspective, businesses typically prefer OpEx rather than CapEx. For example, rather than buying laptops and computers outright for 800 ringgit apiece, a business may prefer to lease it from vendor for 300 ringgit apiece for 3 years period. This is because buying equipment is a capital expense. Even though the company pay 800 ringgit upfront for the equipment, it can only deduct about 250 ringgit as an expense in that year. The entire amount of 300 ringgit paid to the vendor for leasing is operating expense because it was incurred as part of the day-to-day business operations and it can be deducted. We are reaching toward the end of today's presentation, whereby we are going to distinguish between the synergistic effects and environmental effects. First, we are going to talk on synergistic effects. All indirect or synergistic effects of a project should be included in the cash flow calculation. Synergistic effects can be negative or positive. The rationale for the incorporation of these effects has its base in the opportunity cost principle. Now, let's take a look on environmental effect. Product manufacturing often affects negatively on the environment. For example, pollution and waste disposal. The concern for these environmental effects has grown. Companies and upper management are being held financially responsible for negative environmental impact. According to Devonkite, there are 4 stages in capital budgeting and presence considerations that management must make in the budgeting process. Thank you. See you guys next week.